Welcome to the November 20th, 2017 Advance Report for McGowanGroup Asset Management clients and NetWorthRadio.com listeners. One of the most important strategy sessions for 2018 this week, and we're going to go through the facts. Education for investors that leads to great decisions. This is an indictment of the normal decision process for most investors. The data comes from Dalbar and JP Asset Management. Average investor returns for the 20-year period listed here, just 2.3% based upon Dalbar's mutual fund database, money inflows, outflows, and the actual results people are experiencing. That is just 0.2% above inflation. Homes over 20 years, 3.4% average. The bond market, 5.3%. And we're going to delve into your fixed income strategy. I've always said that your fixed income strategy is the key to success with your equity strategy. A 60-40 blend, 60% stocks, 40% bonds, 6.9%. Look at this, 6.5% on a 40-60%, 60% bonds, 40% basically big stocks like the S&P, 7.7%. Real estate investment trust, the publicly traded version of those, 9.7% over that 20-year period. And for most investors, the danger is in the traditional fixed income allocations. There is no mathematical way that this 5.3% can be repeated from a 2% base rate, for example, in the Vanguard Bond Market Total Return Fund, which is at a 6 or 7% premium with a 2.25% yield. This is not going to happen again in that category. But there are other solutions for the fixed income portion. Now we move to what's actually made the most money. This is a 15-year or 10-year chart on total returns. So what fixed income sectors actually provided the best long-term returns? High yield, 105%. Yes, more risk than the treasuries. However, the duration risk of the treasuries is the big concern going forward. You tick up inflation a bit, Fed funds rate likely going to 1.25 on December 13th. Well, high yield, 105% for 10 years. Emerging market debt, 95%. The overall corporate index, 70%. That's 5.5 average return. This one is about 7%. This one's 7.4. It obviously wins. Munis are at 4.7. Most of that tax-free. But the Muni Index, 58%. Treasuries, 48%. Again, we don't believe that number is repeatable. Notice the difference in the fixed income matrix. It's not just one generic allocation. Get out your statements, check your portfolio, because if you've got that generic 2%, you may be very disappointed over the next 5 to 10 years. Real estate investment trust, 10.8%. Emerging market equity, 10%. This is a 15-year chart. High yield index, 9.2, actually better than the one we just cited. Small cap, 8.5. Large, 6.7. Again, about that 7% showing up. Cash, just 1.3. Commodities at the bottom, 1.2. So if they say, do you have a commodity strategy? Well, that may be like saying, do you have an alternate strategy? The other thing you'll see in your pie charts, potentially even selected by an advisor, the 2% long bond allocation that's in danger, duration risk. We're going to present two solutions to that in this weekend's long play program at NetWorthRadio.com. Alex and I go over it in great detail. What is the right strategy going forward? In our opinion, based upon our research, we've got some big events coming up in December. Tax loss selling, Fed funds change in posture, and we cover the bargains both in fixed income and in the high dividend strategy this weekend, because we believe there'll be a big rotation after the first of the year. So come down to the Crescent, meet the team that cares, and we'll do a strategy session after you see the Texas Financial History private collection with real bonds from 170 years ago. Educational. Now, you say, what about that alternate piece? What does alternate mean? Generally, it means a hedge fund, a hedged allocation, and the alternate space. We want to see how they've really done over this same basic time period, 10, 15, and 20 years. Because if you see an alternate piece of your pie, that doesn't mean you're hedged, and it may mean that that's not a good idea at all. Here's why. The most popular strategy in hedge funds, which is the original name hedge, is called market neutral. You short some stocks, betting they'll go down, own some stocks that go up. Just a 2.7% 15-year average annual return. And that was the most popular strategy just based on the true definition of hedge. The composite index, 5.4% average annual return, and that's versus some of the returns that we looked at. So the alternate space, the big experience being more in the 2.7%. If you see that in your pie chart, or you see a fixed income allocation only yielding 2, it is time to come down, meet the team that cares at the Crescent. Go to networthradio.com, fill out the questionnaire, and we'll be back next week with the best in financial news. May God bless you and your family in the holiday week ahead.